Yes. So in the previous video, we talked about the valuations of different sectors in the Indian markets on the price to earning multiples, price to book value multiples, and the EV to EBITDA multiples. And we found out a few sectors that were fairly valued or undervalued. So starting with the private banks, right? So the private banks were trading at a multiple of 2.3x on a price to book value multiple, being lower as compared to the 10-year average of the price to book value multiple of 2.7x. Again, the non-banking financial companies being trading at a fair value, the index being trading at a fair value at 2.3x. Again, the automobiles trading at more than 12% discount. The current price to earning multiple be 23x and the average 10-year price to earning multiples being 27x. Again, the metallic sector is being trading at a fair value on an EV to EBITDA basis. And also the media sector is being trading undervalued, right, as compared to the previous 10-year average. So all these numbers have been shared with you. So now the question arises that should we invest into these sectors blindly? Of course not. We need to understand the fundamentals of the companies while investing into the components of these indices, right? We cannot just blindly invest into the automobile companies, into the IT companies, into with the undervalued private bank companies or the NBFC companies. We need to understand the fundamentals of these companies, the cash flows, the profitability, the activity structure, the capital structure, the management outlook. So all these things need to be understood, and then only we can make an informed decision. Coming to the global markets, the global markets have really started to outperform. If we talk about the Indian markets, Nifty crossing 24,000 levels, Sensex being closer to 79,800 levels, again, the S&P, Nasdaq outperforming. If we talk about the Indian markets, it can be good to go towards the automobile sectors, the private bank sectors, especially because their earnings have been quite solid. But all these things have not been completely translated into price. Their earnings are strong, their profitability, their cash flows are strong. The EPS, the growth in earnings is strong. But at what point of time these lower prices can sustain? A point has to come when these earnings have to be translated to the prices. And we have started to witness that from the May end, right? And we also started to witness that much more closer to the June end quarter, right? Even the IT sector has again started to bounce back, right? Though I completely understand there has been some lower revenue guidance in the IT sector, all these things have been there. But again, the sector bounced back in late June, correct? So whether be it the private banking sector, the NBFC sector, the metallic sector, the media sector, or the automobile sector, or the IT sector per se, which is still in question, the companies need to be analyzed fundamentally, and then only an informed decision can be taken. If we talk about the US markets, right? Again, the core PCE numbers closer to 2%, core CPI numbers closer to 3%, right? The inflation number is coming down. The job openings to unemployment ratio is a bit rising, not by a higher margin, but has started to rise, which clearly shows the job openings are coming down and the unemployment rate is rising, not by a higher margin, but a very minute margin. But the Fed will take these things into consideration. The wage growth is coming down, and all these things stimulate a rate cut, right? Some people expect there would be an early cut in September. Some people say in early December, or some people say the Fed might reduce the interest rates in January 2022, early Jan 2025%. Sorry, my bad, right? So that is the thing. But we have seen the other economies also reducing the interest rates far before the Fed. They aren't following the Fed, like Europe. The ECB reduced the interest rate by 0.25%. The other banks of Indonesia and different other economies also reduced the interest rates. They aren't following the Fed, that they are leading their own way. If we talk about US, almost every sector is positive on a YTD basis, except the real estate, which is down 1.9%. Be it communication services, be it IT, be it financial, be it healthcare, be it industrials, the sectors are up, most of them in early two digits, between 12 to 18%. And also a few other sectors in a single digit, but still the number is positive except for real estate. Chinese market still in question. The multiples being fairly low, closer to 2 or 3 price to earning, price to book value. Most of the fund managers have also started to divert their positions from emerging markets like India, Indonesia, Taiwan, Korea, Malaysia, and Vietnam to the Chinese stocks. Because again, the Chinese market is bound to come back in the further next 1 year. Again, that's just an expectation. European market is becoming too strong in power energy stocks. Again, that is one theme to play, at least from a shorter term to medium term basis. So all these things are really paving a very positive outlook for these markets. like Mexico being too strong in labor, industrials, right? Again, Japanese market, again, a question, though we witnessed a 38-year all-time high. And the market also came down from a negative yield territory, right? The yield curve conversion policy or the yield control policy came to an end. And finally, Japan migrated from a negative or a zero interest policy to at least some positive interest rates. But again, the interest rates are too low to support that currency, right? Again, a lower or a weaker currency can be positive for exports, but still it's a weaker currency. Again, a mark of question. So being overweight on equities in good quality sectors can be a good theme. Coming towards fixed income. So now the question comes, if the interest rates are coming down, it's good to go towards a long duration fixed income securities to get that return. But again, the question is, when will the interest rates come down? Be it September, be it December, or early January, right? So most of the fund managers have also started to maintain a barbell strategy approach, having both short duration fixed income securities and long duration fixed income securities, or going towards or approaching towards a neutral duration strategy to make that number of duration neutral to hedge your portfolio, or going towards an intermediate or medium term notes or fixed income strategies to hedge your portfolio, right? By taking some positions in interest rates overlays, in swaptions, interest rate swaps, by taking some positions in spread durations, time spread durations, and all these stuffs, right? Which can help to make the return for investors in fixed income markets. But now the question comes, like within the fixed income markets, like which fixed income? Though we talked about a barbell approach having both long duration or short duration, or either towards approaching the interest rates cut, a higher approach towards a long duration fixed income strategy. But the question comes towards an high yield fixed income security and investment grade securities. Because as per different market models, the interest rates commanded upon these securities, be it your high yield and IG, is converging, right? So that is one thing. But still, at this point of time, high yield offering you between 8 to 9%, being fundamentally and technically very strong. That is one thing. But over a long term, we need to understand about the spreads being compressed between IG and HY universe and other high yielding and not so high yielding securities. Again, compressing spreads is again good for the market. It supports the fundamentals, technicals, improves stability, but also states that the demand for the high yielding asset is coming down. So if the spread between the HY and IG is coming down, it means the demand for the HY securities is coming down. So that is one more thing, because as the market breadth widens, the volatility and the risk also increases in the fixed income market. So that is one thing. Shortening positions in 0 to 3 years maturity can be a good one, though they're offering you high yield because of an inverted yield curve. But the problem is they will give you just carry and not total return. If you guys want both total return and carry, try to go towards at least a 4 to 5 year maturity or duration fixed income securities investment. Also, people have started to go towards convertibles, right? Which has both the proportion of equity and fixed income, correct? If the interest rates are going down, right? So in that case, like what will happen? The fixed income component will rise accurately, correct? The fixed income portion of that convertible instrument, a hybrid instrument, will rise if the rate of interest are coming down. And when the rate of interest went up, the value of the fixed income securities came down, but all those call options were taken upon those embedded securities, which try to hedge your convertible position. And because if one side of the fixed income is going down, the position through calls or options is increasing your equity position and vice versa. In case of convertibles, again, that's a good strategy to go for, because convertibles might offer you a lower duration, but higher spread duration. And most of the strategies people are going towards, in case of investment grade bonds, if I talk about, lower on spread duration, being underweight on spread duration and overweight on time spread duration, which takes into consideration the relative impact of the change in the credit spread instead of absolute. Because the spread duration, it takes into consideration the absolute impact of the credit spread, whereas the time spread duration takes into consideration the relative change in the spread of two fixed income securities. That is one thing. Also, we can go towards long on USD, because again, USD being too strong, the USD is not accepting to come down. Again, it's too strong. The private market, the credit market, again, is a very strong market. So again, we can say, as an overview from my perspective, rest, you guys have to do your own research, because here I'm not advising or suggesting upon anything. I will just say be overweight on equities, being overweight on equities, constructive on credit, long on USD, and neutral on duration. That's it. Thank you, guys.